A severe sell-off has intensified, pushing indexes into bear market territory and sending inflated equities into a free fall that only matches the decline experienced during the dot-com implosion. As inflation continues to climb despite the Fed's efforts to control it, investors are in a panic. What's good, you guys? It's Market Thrive once again. And today, we'll be talking about the possible stock market crash that will eventually happen in the near future. Before we start the video, I would just like you to do me a favor by just hitting that subscribe button and the bell notification down below to keep you updated on this channel. So without further ado, let's hop into it. After a highly poor May Consumer Price Index report was issued on Friday, which revealed that inflation in the US is still worsening rather than improving, stock markets experienced a widespread sell-off this morning. Inflation surged in May, jumping 8.6% year over year, the highest increase since 1981 according to the most recent CPI data. A recent bear market rally, despite rising risks, was supported by a mild April CPI figure that only a few months earlier had given rise to hopes that price hikes were slowing down. However, a significant turnaround is currently underway, with almost every signal pointing to an economic slowdown. According to the preliminary June reading of the Consumer Sentiment Index from the University of Michigan, consumer confidence in the U.S. economy has plummeted to 50.2, which is a record low for the series since data collection began in the middle of the 1970s. Almost half of the consumers surveyed blamed soaring living costs for their deteriorating outlook. At midday today, the tech-heavy Nasdaq Composite was down 4.19%, the Dow Jones Industrial Average was down about 2.5%, and the S&P 500 was down 3.76%. The losses incurred since Friday show just how disappointed the market is in the CPI inflation statistics. The Federal Reserve will essentially need to tighten policy even more forcefully in order to be able to stop inflation rise, which is really terrible news for an overheated stock market. Chief economist for Comerica Bank Bill Adams noted, quote, "With the Federal Reserve mostly on autopilot through the June and July decisions, the latest CPI release argues against a pause in rate hikes in September," end quote. Similarly, Michael Hartnett, the chief investment strategist at Bank of America, recently sent a note to clients warning that the current stock market meltdown is much worse than anyone understands. In his most recent flow show note, Hartnett laments the continued decline in both equities and credit, asking, quote, "Where's my bear market rally gone?" end quote. Although a bear market rally has been in effect for nearly 9 weeks, the strategist emphasizes that the sell-off that is causing the market to crash is still ongoing. In fact, BofA's Bull and Bear indicator is currently just above all-time lows and in very bearish zone. Given that the inflation shock has become an indisputable reality, Hartnett adds that there is currently a dramatic change in investor attitude. Natural gas prices increased by 141%, gasoline prices by 91%, oil prices by 61%, while wheat and corn prices grew by 39% and 30% respectively in the first quarter alone. That brings us full round to addressing Hartnett's important question, where's my bear market rally gone? He says that because inflation hasn't reached its peak yet, equities won't be able to recover. He contends that the Fed's rate shock is just getting started and that a material slowdown in economic growth will also play a role in the collapse of the stock market. Investors will panic more about tightening credit conditions as policymakers panic more about persistent inflation, fueling the downward spiral and causing a manic depressive shift. Stock markets are prone to these sudden shifts in sentiment, going from extreme optimism to undeserved optimism in the span of just 1 or 2 trading sessions. Additionally, the Federal Open Market Committee's FOMC meeting tomorrow will have a significant impact on investor sentiment. The target rate for federal funds is currently expected to range between 1.25% and 1.5%, with markets already pricing in an 86% possibility of another 50 basis point rate increase. Additionally, it accounts for a 91.2% likelihood that rates will be higher than 2.75 by the end of 2022. For the time being, Wall Street insiders predict that the sell-off will pick up speed. Investors are seeking safe havens, as seen by the fact that the dollar is rising in response to the news. Market turbulence is probably going to persist, said Jeffrey Roach, chief economist at LPL Financial, quote, "Investors' tendency to sell whatever they can have been contributing to a staggering drop in valuations after peaking above 30 times earnings a year ago. The S&P 500's multiple shrunk by roughly 40% through its trough in May, almost matching the size of the decline during the entire 2000 to 2002 crash," end quote. In other words, The correction devaluations are currently occurring 3 times more quickly than the internet bubble's deflation. According to Bloomberg Intelligence's Gina Martin Adams, quote, the rapid drawdown reflects how much the post-pandemic equity rally relied upon the Fed. Once the central bank turned hawkish, the collapse has been vicious. When easy money disappears, the bubble disappears, end quote. Market psychology regarding growth potential and stock ownership served as the basis for the boom in the 1990s. The latest bubble, it was noted, was harder to burst as it was largely built on speculation and artificially low loan rates. Salim Abraham, a fund manager who's in the top 5% of his category this year, has shared a series of dire warnings about a stock bubble burst that is now in progress. 34-year market veteran asserts that a stock market crash and economic meltdown akin to the Great Depression cannot be ruled out for 2022 and that a sharp double-digit loss might erase a fourth of the market's gains in a single day. Quote, I see this downfall, and I'm just like, this is really nothing, Abraham said in an interview with Insider. There's a way worse scenario than this. People have both a short memory and lack of respect for history, he said. We may just be setting up for a 25% drop in one day, end quote. Abraham predicts. Rich investors won't be the only ones who lose money if the doomsday scenario comes true. He cautioned that too much reliance on markets may destroy college endowments and worker pensions. Simply put, we might be facing an economic calamity unmatched by anything we've ever known. Actually, Bank of America's Hartnett stated in a study that the majority of people simply aren't aware of it yet, despite the fact that we're already in a technical recession. During the first quarter, the US GDP shrank by -1.5%. As consumer spending hits a wall, the Atlanta Fed predicts a pitiful 0.9 GDP growth for the second quarter. There are others who have issued warnings about an imminent economic downturn besides Abraham and Hartnett. However, the chief U.S. equity strategist and CIO at Morgan Stanley suggested that stocks still have farther to go before reaching their bear market bottom in the Sunday note. We continue to believe that lower pricing are yet in store, Wilson stated. Wilson also stated that the likelihood of a recession has considerably increased, which is what Morgan Stanley's bear case currently anticipates. Due to persistent margin erosion, high inflationary pressures, and a general slowdown in sales growth, the U.S. will enter a recession in the upcoming months. In a similar vein, Lloyd Blankfein, the former CEO of Goldman Sachs, asserted that the current recession risk is quite high and predicted a significant recession to hit the U.S. economy before 2023. The house of cards will fall sooner rather than later. The anxiety and suffering that lie ahead are going to be unbearably severe, much more so than the majority of Americans will be able to bear. So what do you think about all this? Do you think you're prepared for all this? Feel free to jot down your thoughts in the comment section below. If you enjoyed today's video, please leave a like. And if you want to stay updated on our posts, hit that subscribe button as well. Once again, this is Market Thrive signing off.